If you're receiving Social Security right now or planning to start within the next few years, you need to stop what you're doing and listen carefully. There are 3 changes happening in 2026 that will reduce your real Social Security benefits by 20 to 30% over the next 5 years. And nobody is talking about them. Not the news, not your financial advisor, and certainly not the Social Security Administration. Most seniors believe Social Security is safe. It's guaranteed by the government. It adjusts for inflation. And as long as you've paid into the system, you'll get what you were promised. That belief is dangerously wrong. The system is quietly breaking down in ways that aren't obvious on your monthly statement, but are devastating to your retirement security. Let me be very clear. This is not about Social Security running out of money completely. That won't happen for another 10 to 15 years. This is about the silent erosion of your benefits through policies that haven't been updated in decades, cost of living adjustments that don't reflect real senior expenses, and taxation rules that steal more of your benefit every single year. By the end of this video, I will show you exactly what these 3 changes are, how much they're costing you, and most importantly, what you can do right now to protect yourself. This is not theoretical, this is happening. And if you don't prepare, you could lose $50,000 or more in benefits over the next decade. I want to start with the most insidious change, the one that hurts seniors the most but is completely invisible on your Social Security statement. It's called the tax torpedo, and it's about to get much worse in 2026. Let me explain how Social Security benefits are taxed, because most seniors don't understand this, and it's the biggest leak in your retirement income. In 1983, Congress passed a law that made up to 50% of your Social Security benefits taxable if your income exceeds certain thresholds. In 1993, they increased that to up to 85% taxable for higher incomes. Here's the thing, those income thresholds have never been adjusted for inflation. Not once. In 40 years, the threshold for single filers is $25,000. For married couples, it's $32,000. These numbers were set in 1983. If they had been adjusted for inflation, they would be about $75,000 for singles and $95,000 for couples today. But they're not. They're still at $25,000 and $32,000. So what does this mean for you? It means that every year, as your cost of living adjustment increases your Social Security benefit, and as you take required minimum distributions from your retirement accounts, you're more likely to cross these outdated thresholds and have more of your benefit taxed. And in 2026, with the new COLA increase and RMD ages changing, millions of seniors will cross these thresholds for the first time. Let me show you what this looks like with real numbers. Let's say you're a single senior getting $2,000 a month. In Social Security, that's $24,000 a year. Under the current rules, if you have other incomes from a part-time job, IRA distributions, or investment income that pushes your total income above $25,000, suddenly 50% of your Social Security benefit becomes taxable. If your total income goes above $34,000, 85% of your benefit becomes taxable. So you're repaying federal income tax on Social Security money that you already paid Social Security taxes on when you earned it. It's double taxation, and it's going to affect more seniors in 2026 than ever before. Here's the projection. In 2023, about 40% of Social Security beneficiaries paid taxes on their benefits. By 2026, that number is projected to be 60%, and by 2030, it will be 75%. 3 out of 4 seniors will have their Social Security benefits taxed, all because these thresholds are frozen in $1,983. And the real kicker? The Social Security Administration doesn't withhold federal taxes from your benefit automatically. You have to request it. So many seniors are getting hit with huge tax bills in April that they didn't see coming. They owe thousands of dollars they don't have, and they have to choose between paying the IRS and paying for medication or food. This is the tax torpedo. It sinks retirement plans silently, year after year. And in 2026, it's going to hit more seniors than ever before. Now, let's talk about the second hidden change, the cost of living adjustment, or COLA. Every year, Social Security beneficiaries get a COLA increase based on the Consumer Price Index for urban wage earners and clerical workers, or CPI. In 2025, the COLA was 2.5%. In 2024, it was 3.2%. Over the last 10 years, it's averaged about 2.8% per year. Here's the problem. CPIW measures inflation for working people, not seniors. It weights things like electronics, clothing, and transportation heavily. But seniors spend a much larger portion of their income on healthcare, housing, and food, and those costs are rising much faster than the general inflation rate. Healthcare costs for seniors are rising 6 to 8% per year. Housing costs are rising 5 to 7% per year. Food costs are rising 4 to 5% per year. But the COLA is based on CPIW, which is rising 2.8% per year. This means that every year, your Social Security benefit is losing purchasing power. Your COLA increase is not keeping up with your actual cost of living. And over time, this compounds into a massive loss of real benefits. Let me show you the math. If you get $2,000 a month in Social Security, and your real costs are rising 5% per year, but your COLA is only 2.8% per year. You're losing 2.2% of purchasing power every year. Over 10 years, that's a 22% loss. Over 20 years, it's a 40% loss. By the time you're 85, your Social Security benefit might have gone up in dollar terms, but it buys 40% less than it did when you started. And this is by design. The government knows that CPIW understates senior inflation, but they refuse to change it to a senior-specific index because it would cost them hundreds of billions of dollars more in benefits. In 2026, this gap is getting even wider. The CPIW is projected to be around 2.5%. But senior-specific inflation is projected to be 6.2%. That's a 3.7% gap, the biggest gap in history, which means 2026 will be the year seniors lose the most purchasing power from their Social Security benefits. And here's the cruel irony. While your benefit is losing purchasing power, you're more likely to be taxed on it because of the outdated thresholds we just talked about. So you're getting hit from both sides. Double taxation and inflation that outpaces your increase. Now, the third hidden change, the Social Security Trust Fund. You've probably heard that the trust fund will be depleted in 2033 or 2034, but what you haven't heard is that the depletion is accelerating, and the solutions being discussed will effectively cut benefits for middle and upper income seniors. Here's what's happening. The Social Security Trust Fund is the surplus that was built up over decades when payroll taxes exceeded benefits paid. That surplus is invested in special treasury bonds. But since 2010, benefits paid have exceeded payroll taxes collected, so the trust fund is being drawn down to make up the difference. The most recent Social Security Trustees Report says the trust fund will be depleted in 2033. At that point, payroll taxes will only cover about 75% of promised benefits. So unless Congress acts, everyone's benefits will be cut by 25% in 2033. But here's what they're not telling you. Congress will act. They won't let benefits get cut across the board because that would be political suicide. What they'll do is means test benefits. They'll say that seniors with higher incomes or more assets don't need their full benefit, so they'll reduce benefits for those seniors to preserve benefits for lower income seniors. This is already happening in subtle ways. The taxation of benefits is a form of means. The IRMAA surcharges for Medicare are means, and there are proposals in Congress right now to increase the payroll tax gap, which would effectively reduce benefits for higher income retirees relative to their contributions. In 2026, we're likely to see the first major piece of legislation that addresses the trust fund depletion, and the most politically palatable solution is to reduce benefits for seniors with retirement incomes above a certain threshold. That threshold will likely be around $50,000 for individuals and $75,000 for couples. So if you have a pension, IRA distributions, or investment income that pushes you above those thresholds, you can expect your Social Security benefit to be reduced even before the trust fund is depleted. It is a backdoor benefit cut that allows politicians to say they preserved Social Security for those who need it most, while effectively cutting it for the middle class. And the worst part, there's no way to opt out. There's no way to get your payroll taxes back. You've paid into the system for 40 years under one set of rules, and now the rules are changing in the final quarter of the game. This is the trust fund deception. The promise that if you pay in, you'll get your promised benefit. That promise is breaking down, and 2026 is the year the cracks become impossible to ignore. But here's the good news. There are things you can do right now to protect yourself, and they don't require you to change the law or fight Congress. They just require you to take control of your financial planning and stop relying on Social Security as your primary safety net. Step 1. Understand your real benefit. Most seniors have no idea what their Social Security benefit is actually worth in purchasing power or how much they'll lose to taxes. You need to calculate your net benefit after taxes, after Medicare premiums are deducted, and after accounting for the inflation gap. That number is your real retirement income, and you need to plan around it. You can do this by looking at your last Social Security statement, adding up your Medicare premiums, estimating your federal tax liability using the outdated thresholds, and subtracting the inflation gap. That final number is what you actually have to live on. And for most seniors, it's 20 to 30% less than they think. Step 2. Maximize your tax efficiency. If you have retirement accounts, you need to be strategic about when and how you take distributions. Every dollar you take from a traditional IRA or 401k is taxable income that can trigger the Social Security tax torpedo. So you need to balance your distributions with Roth conversions, maybe in years when your income is lower, to reduce the long-term tax impact. You should also consider delaying Social Security if you can afford to. Every year you delay past full retirement age, your benefit increases by 8%. That increase is guaranteed. It's inflation protected and it's tax advantaged. If you can live off your retirement savings for a few years, delaying Social Security can dramatically increase your net benefit over your lifetime. Step 3. Build multiple income streams. The seniors who will be hurt most by the Social Security changes are those who rely on it for 80 to 90% of their income. If that's you, you're in a dangerous position. You need to diversify your income. This could mean working part-time in your 60s and early 70s. It could mean developing a side business based on a hobby or skill. It could mean renting out a room in your home or downsizing to free up equity. It could mean investing in dividend-paying stocks that generate income without triggering the Social Security tax thresholds. The key is to have at least 3 sources of retirement income: Social Security, retirement account distributions, and something else. That something else could be a pension, part-time work, rental income, or investment income. But you need that diversification to protect yourself from policy changes you can't control. These 3 steps won't stop the Social Security changes. They won't preserve the system in its current form, but they will give you options. They will give you flexibility. They will give you the ability to adapt to a changing retirement landscape. The Social Security crisis is real. The 3 hidden changes are happening, but you don't have to be a victim of them. You can be prepared, you can be proactive, you can protect your retirement. If this video opened your eyes to something you didn't know, please share it with other seniors who need to hear this message. Like it, subscribe to the channel, and comment below with your Social Security questions. I read every comment, and I'll do my best to point you toward resources that can help. Thank you for your time. Take action today. Protect your tomorrow.